Good afternoon. I'd like to warmly welcome you to this webinar about the complete course in risk management at Imperial College Business School next year. My name's Robert Kosowski, and I've put together an expert team to deliver the course, but before I describe the course to you, I'd like to briefly introduce myself. I've been at Imperial for 10 years. Before that, I taught at a business school in France called INSEAD, and I've divided my time for the last 15 years or so between industry consulting work and academic research and teaching. My main areas of interest are in the areas of risk management, financial engineering, derivatives trading strategy, and I've had a chance to work as specialist advisor to the House of Lords as expert technical consultant for the International Monetary Fund on several occasions, and Goldman Sachs and Deutsche Bank. I've woven this industry experience into the design of the course, and the objective of the course is to provide you with tools and insight which you can integrate into your daily decision making. So make it improve your work experience and improve your risk management skills. So one key question at the outset that we should discuss is, why do we need risk management, or why do we need to think about risk management? And to some extent, I think of it as a boxing match in a sense when it comes to risk management. So you may say that risk management is there to avoid bad outcomes, but the way that I think about it is risk management is partly about avoiding being knocked out. A boxer needs to stand to continue scoring points, and similarly companies must ensure that they are there to earn revenues and avoid bad outcomes. But more importantly, risk management is fundamental to performance and profit making, because companies and shareholders and regulators now think about risk-adjusted performance, and this applies not only to the return on equity, it also applies to risk-weighted assets, for example, be it in banks or insurance companies or other organizations. So risk management is really part and parcel of profitability, and it's something that concerns senior management, but also boards of directors, increasingly so, as we will soon see. On slide 4, you see a fishbowl and or a fish tank, and in a sense what we have is we've got an analogy for how companies and financial institutions have to operate in a new regulatory landscape that is placing increasing demands on institutions in terms of their transparency to the outside, their transparency about their internal risk management processes. And this transparency affects not just banks and insurance companies, but also many corporates. Increasingly, their shareholders want more transparency, but also the boards of directors are increasingly held to account when it comes to risk management failures, and it's therefore at the forefront of their mind. On slide 5, I want to describe some of the things that are part of risk management, but are often not thought about, and parts of innovative risk management and related to the pedigree of Imperial. So there are changes in technology and regulation that mean that new risks that previously had not been considered, so risks potentially outside the standard market risks and operational risks that we need to think about. Cybersecurity is an important one. Here in the United Kingdom, we've recently had a report about a hacking attack on a bank, on Tesco Bank, that has led to potentially millions of pounds of losses. There are reports from Bangladesh that a hacking attack on the central bank led to hundreds of dollars of losses. A recent report in Citibank also reviewed the issue of large hacking attacks and the costs on the financial system, which run in the billions of losses per year. So cybersecurity is an important risk. It's also something that the Data Science Institute here at Imperial is actively researching, and other researchers at Imperial are very active in. Basel III, as a new regulatory framework, places increasing demands on companies and banks to think about risk weighting, risk budgeting, and this is something that we will also discuss in the course. Climate change affects us in many different ways. It affects us, as the governor of the Bank of England recently said, in terms of the profitability of the financial system and corporates at large. It affects insurance companies directly through insurance payouts. It affects in financial markets through emission markets and new derivatives and ways of hedging climate change. And the Grantham Institute of Climate Change at Imperial is one of the leaders in this area, and we will also discuss some of the new risks and their risk management related to climate change. One of the contributors on the program is Professor Damiano Brigo from the Maths Department, and he's one of the global experts on counterparty risk. Now, following the financial crisis, one of the big changes in risk management in financial markets is the recognition of the importance of counterparty risk. At a very fundamental level, it changes the way that we value derivatives because we recognize that counterparty risk differs depending on which side of a particular transaction one is on, whether one is one or the other counterparty, which means that there is no universal true price anymore necessarily to the transaction. And both practitioners that work on so-called CVA desks and academics fundamentally agree and haven't quite settled on what is the best way of dealing with counterparty risk. Through the use of central clearing and increase of the use of margins in financial markets and derivatives transactions, there may be an increase, according to the TAB group, of several $1 trillion in terms of new capital that will need to be set aside for derivatives transactions. So this is a material first-order impact on financial markets and risk management. And Damiano Brigo will discuss the basic concepts, but also practical challenges and latest solutions in this area. At Imperial, we have an engineering pedigree, a science pedigree, and one of the presenters and instructors on this course is an expert in the area of space weather and new risks such as risks related to weather and terrorism risks. And Enrico Biff is active in gauging the cost of solar storms. And again, this is one of the key exotic and new risks, but again of first order importance. The estimates run to the trillions of dollars in the case of a major solar storm and the knock-on effects on infrastructure, on electrical grids, and on financial systems and communication systems. Risk management has also changed in recent years in terms of its reliance on large data sets and computational power. And as a research committee member of the Data Science Institute at Imperial, I am very interested in big data, and as part of this course we will also talk about the use of big data for risk management systems, including, for example, operational risk, but also enterprise risk management. So these are some of the exotic, new, innovative future risks that we will discuss, in addition to the basic risks such as market risk and interest rate risk and operational risk. To illustrate the cost of regulation and capital requirements, I've provided you here with a snapshot from the Financial Times, where due to new regulation that will increase capital requirements for banks that are deemed global, systemically important financial institutions, so-called G-SIFIs, there is an estimate that the increase in the capital requirements for these 29 banks that have about $46 trillion of assets may mean a $566 billion increase in capital, which of course will have very significant impacts on their risk-weighted assets, but also their profitability, and their return on equity is estimated to decline to 8.5% from 10.8%. So as managers or employees of some of these banks, or as counterparties, it is crucial to understand how these banks will be impacted by new regulation, but also how they can efficiently respond and manage the business in order to minimize potential capital charges while fulfilling regulatory requirements. On slide 7, we also need to acknowledge that risk management has changed since the financial crisis, and the last 10-15 years as boards of directors have been increasingly held accountable for risk management failures. And boards have now been shown to spend significant amounts of time to discussions regarding risk management. There is also an increased focus on enterprise risk management. Enterprise risk management will be covered in the last day of this course by a senior practitioner that has had extensive experience implementing enterprise risk management systems. Marcus Krebs will look at a portfolio of risks, so not individual risks, but viewing the entire enterprise, all of the risks that it is exposed to, and how these risks interact, and how the management of the company or the enterprise reflects these risks and optimally manages them. So risk management, enterprise risk management, is an integral part of all other aspects of management and shareholder return maximization. One of the insights that can be gained from very successful financial firms, including leading hedge funds, is that they pay a lot of attention to stress tests. This also includes clients such as the International Monetary Fund that I've consulted for. Instead of looking at statistical measures such as value at risk, they consider certain scenarios. These could be historical events when one looks at large losses in, for example, 2008 or 2001 or 1998 during the Asian financial crisis, but also hypothetical scenarios, in which case we stress the system or we stress portfolios or stress the balance sheet to see how it would respond in particular circumstances where we simulate certain movements in interest rates, exchange rates, market indices, and see what the conditions, what the results are. This is quite different from Monte Carlo simulations or VAR simulations, which would look at average losses. It really looks at understanding the reactions of the portfolio and the balance sheet under stress scenarios, and this leads then to follow-on discussions asking whether the organization is optimally managing these risks, whether it is taking appropriate risks, whether these risks are compensated for by sufficient return. Finally, something that is very important is also related to conduct risk and risk culture. Regulation on its own cannot improve the risk management behavior of the company, and risk management rules also can't necessarily bring about optimal risk management behavior unless it is part and parcel of the culture. So our practitioners, including former members of the Bank of England Monetary Policy Committee and members of the Board of Directors of the Central Bank of Cyprus, will discuss how building a risk management culture in organizations helps improve risk management practice. Slide 8 provides some of the statistics that I've described. A survey has recently found that 92% of respondents indicated that their institutions are paying more attention to enterprise risk management than in previous years. So there is an acknowledgement that risks affecting the enterprise or bank or company have to be seen as a portfolio that interact with each other and cannot be separated from considerations regarding profitability. 85% of respondents said that their board of directors regularly devotes more time to oversight of risk than it did 2 years ago. And the prevalence of chief risk officer, CRO positions also continues to grow, reflecting this increased regulatory attention, reflecting the priorities of the board of directors and management, and also reflecting the complexity of the risk environment that global institutions have to operate in. This survey also looked at which risk types organizations calculate economic capital for, be it for regulatory purposes or for internal capital budgeting purposes. And in addition to market and credit risk, which we will discuss on day 1, 2, and 3 of the course, operational risk is very important, and this will be discussed on day 5 of the course. We will also highlight insights that can be learned from the energy industry. Consider operating a nuclear power plant. Risk management in the nuclear power industry is very sophisticated, and when you look at the risk culture in financial markets before 2008, it's generally acknowledged that it has not been as rigorous as that in the nuclear industry, and there are certain insights that can be learned, which we will highlight also in the form of a so-called lab simulation. We will also then discuss the context of the contributions of Damiano Brigo, counterparty credit risk, what counterparty risk is, how it should be measured, how it is practically measured, also potential regulatory arbitrage, what leeway there is in measuring it, other than how the consensus approaches us at the moment. We will also discuss interest rate risk of the balance sheet in the context of a Harvard Business School study called Bancorp 1 on day 1. And we will also look at liquidity risk, catastrophe risk, as I mentioned, in the context of solar storms, for example, but also climate change. Now, the learning objective, as I mentioned, due to the practical experience of all the instructors on the program, is that we want you to develop financial foresight. So as opposed to making predictions about what will happen in the future, what risks may be relevant, we will provide you with a structure, a framework, how to think about different markets, business models, and also physical dynamics, including solar storms, and how you can develop financial foresight so that you can make predictions regarding societal, financial, corporate, or environmental risks. So this will be reflected in my modules in the form of looking forward, so to speak, assuming the windscreen view when you drive as opposed to the rear view mirror view. I will spend a lot of time thinking about predictability and forecasting when it comes to market risks, interest rate risks, credit risks. Consider the recent elections in the United States. We've seen a view that potentially large infrastructure spending, loose fiscal, potentially loose monetary policy could lead to higher expected future short-term interest rates, which has already led to a steepening of the yield curve, and it's also reflected in FX markets. And these are some of the relationships that we will introduce in the first 2 days to create a level playing field regarding your understanding of market risk, interest rate risk, and credit risk, as well as FX risk. Now, what we will also do is we will discuss how to measure risk. During the first day, we will have a module that will talk about statistical risk measures. Some of you may be familiar with them, some of you may not be familiar with them. We will introduce them, create a level playing field, and then show how they can be used for hedging risks. Finally, we will also talk about how risk management practices are evolving, partly in response to regulatory requirements, but also partly as a result of insights from the recent financial crisis. And as part of integrating these insights into your decision making, we also talk about corporate governance, how the corporate governance inside institutions is crucial for an efficient risk management system, but also how to make sure that risk management insights are incorporated into daily management, how risk measurement actually is translated into changing the way that management makes decisions, changes its strategic plans, and changes how the company operates. Unless we understand potential impediments in terms of corporate governance, malfunctions to improving risk management, we would not be able to implement these improvements in practice. Now, who should attend? This course, over the last 3 years that it has been running, has been attended by senior professionals from many different areas, some with a technical computer science background and an interest in insights from the financial industry, as well as very senior managers from the financial industry that wanted to update and broaden their knowledge of risk management developments. We've had chief risk officers, but also market, credit, liquidity, and operational risk specialists. We had representatives from regulatory bodies. We had representatives from sovereign wealth funds, including one of the largest global sovereign wealth funds from the Middle East, but also from Asia. We had operations and IT personnel. There were, for example, participants from Oracle last year that operate very large risk management systems in practice. And we had a very fruitful exchange in which I learned from participants, but also shared my knowledge with them, just as my colleagues did. And participants also shared knowledge between themselves. We had a very senior manager from BP, for example, and we had an interesting exchange between, for example, best practice of risk management in credit card companies, sovereign wealth funds, rating agencies, large energy companies. And this is one of the unique settings that we managed to create by carefully selecting participants and having a very high quality team of instructors. What are the benefits for your organization? Well, the course, by enabling you to have financial foresight, as opposed to just looking at a historical interpretation of events, by enabling you to have financial foresight, it will enable you to better deal with medium and longer term challenges that your institutions faces. But also by learning to innovate, for example, in the areas of big data, or by learning from the nuclear power industry, you will be able to innovate and improve risk management practice. We will highlight through the consulting experience of a lot of us the practical challenges of implementing risk management improvements. Any change and improvement in the company, of course, has to go through a process. We're dealing with people, with committees, with institutional constraints. And all of this is sometimes described as corporate governance, organizational behavior, and we will be very much attuned to how this can present obstacles and opportunities, and discuss how in your organizations some of the innovations that we will discuss can be implemented. Now, what makes this program unique? I've already highlighted the engineering pedigree, the science pedigree that permeates the program. We are, on the one hand, quantitative and rigorous, but at the same time very practical. Imperial, since its inception, has worked with industry on relevant research, and this will be part and parcel of the course. A very interesting case study during the first day that I'm very proud of is the so-called Impact Lab, in which we have an experience of a risk management simulation in the carbon capture lab. We have a unique facility where over 3 floors there is an engineer that operates a miniature power plant and carbon capture storage facility, and you will be exposed to this environment and a risk management simulation that will make some of these concepts very tangible, more tangible than we would experience in a lot of say financial institutions. But this has been a very popular, very successful exercise that I personally enjoy and all the previous participants have enjoyed. And it is something unique to Imperial and reflects the practical focus of the program. The timeline of the program is as follows. Day 1, we will have the introduction, a big picture of risk management, explaining to you how the different learning points will fit together into a big picture over the course of the week. Then we will have the carbon capture simulation. It will give you a real-world, very physical, very tangible experience of risk management, and will also be an opportunity to bond as a team, as a group, with the other participants and instructors. And we will build on this lab simulation to discuss risk measures and statistical measures before coming to market risk and credit risk, counterparty risk, and market risk measurement. As an example, on day 5, we will then also talk about capital allocation. We'll have a former member of the Bank of England Monetary Policy Committee talk about current and future regulatory capital regulation. He will share his experiences of navigating the Bank of England through the global financial crisis. We also have a former member of the the board of directors of the Bank of Cyprus who will contribute to this. And finally, we will tie all of the different components together in the enterprise risk management view and discuss how stress testing can inform enterprise risk management. We will also discuss people and conduct risk and risk culture, and think practically in discussions as a group about how some of these insights and tools and case studies can be implemented in your organizations. Now, you have an opportunity to ask questions through the chat, and I will be available to answer questions now. So if you want to write your questions through the chat functionality, I will reply to them. My colleague Julie Coyne will address any more logistical questions. So it seems there are no questions in the chat. Let me thank you for your time and interest in the course. I hope to welcome you next year and work together with you on the course. If you've got any further questions, don't hesitate to contact Julie Coyne or myself, and we'd be more than happy to give you more details about the course and also talk in person if you'd like to do so. I would like to thank you again and wish you a very good afternoon.